So the big question, what's better, overpaying your mortgage or investing regularly into the stock market each month? In this video, we'll talk about the pros and cons of each of the two, and hopefully by the end, you'll be able to make the decision that's best for you. Let me know in the comments, what's your preference? Are you one to overpay your mortgage, or do you prefer to put all your money in investing? Or maybe you do something in between. When considering overpaying your mortgage or investing, there are two big factors to consider. The first is the maths, the financial impacts of that decision. And the second is the psychological impact and the reassurance perhaps of overpaying your mortgage and knowing it's going to be paid off sooner. Both are really big factors and neither one is more important than the other. They both come down to whatever is more important to you personally as an individual. But to help you work out which of those two things to think about maybe the most for your situation, let's break them down and take a look at them individually. And to do this, we'll use two fictional examples, Ben and Sarah. Sarah prefers to overpay her mortgage each month, and Ben instead prefers to take any spare cash he has and invest it in the stock market. We'll make some assumptions here that both Ben and Sarah each have a £200,000 mortgage over 25 years and that they each have an interest rate on that mortgage of 4.5%. As well as their mortgage, we'll also assume that both of them have £10,000 as a lump sum that they're going to put into their investments at the same time as starting their overpaying or monthly investing journey. For any investing that Ben and Sarah do, we'll also make a fairly conservative estimate that they might make a 6% return on those investments each month. And if we use the S&P 500 as an example, one of the most popular places for people to invest, that's the American kind of index fund stock market. That has historically over the last few decades returned on average 8 to 10% returns. So a 6% return in this example is definitely on the lower end and could definitely be higher in reality. So now let's fast forward 25 years and see how both Ben and Sarah have done. Sarah, who chose to overpay her mortgage, actually ended up paying her mortgage off 6 years and 1 month earlier than the original 25-year plan. That means since then she's taken that extra £200 a month that she's been overpaying her mortgage, plus her £1,110 mortgage payment, and therefore putting all of that into monthly investments, which for the final 6 years and 1 month of our example means Sarah was paying £1,310 a month into the stock market. And therefore, at the end of the 25 years, Sarah is mortgage free, but her investment pot sits at £159,721.27. She also saved over £36,000 on interest that would have otherwise just gone to the bank in interest payments for her mortgage. But how does this compare with Ben? Remember, Ben didn't overpay his mortgage. Instead, he took the extra £200 a month that he had and put it into the stock market. At the end of the 25 years, Ben paid off his mortgage as planned at the end of the full 25-year period. But aside from that, he also had an investment pot worth £183,248.49, as well as being mortgage free. So in our example here, Ben is the winner and he has over £23,000 more than Sarah does, as well as being mortgage free. Despite Sarah being mortgage free sooner, it just wasn't soon enough for her to make those investments at the rate that she needed to end up with more money than Ben at the end. But why did Ben come out on top? It's all down to the difference in the interest rates on the mortgage versus the potential return by investing. In our example, investing returned at 6% each year versus the mortgage interest rate, which was 4.5%. Therefore, by the investing option having a 1.5% higher investment return, it meant that whatever happened, the person that did more investing was going to end up with more money, in our case, Ben. If the reverse were true, if the mortgage was a higher rate of interest than the potential returns, let's say a mortgage of 7% versus an investment return of 6%, it would therefore be mathematically beneficial to overpay your mortgage because you'd get that 7% return versus the only 6% in the stock market. But regardless of this, one of the other things to consider is the certainty of overpaying your mortgage versus the uncertainty of investing in the stock market. When I talk about those 8 to 10% returns in the S&P 500 stock market over the last few decades, that is an average over that period of time. The reality is much more that in some years it's up 30%, in other years it's down 40%, and then maybe it's break even for a couple of years, but the average over that 2-3 decade period is around about 8 to 10%. So if you're not prepared to ride that wave of peaks and troughs of the market, then maybe investing isn't right for you. Maybe you want the certainty of overpaying your mortgage, the definitive, tangible money that goes each month towards your mortgage principal if you overpay. And remember, there's no right or wrong answer here. It really comes down to what's more important to you. If you prioritize the financial return on your money, then you definitely need to pay attention to the differences in your mortgage interest rate and the potential returns you have in the stock market, and favor the one that is going to give you the better financial return. But remember that second big consideration we talked about at the start, the psychological impact, the potential peace of mind. Knowing that your mortgage is going to be taken care of can be a really, really reassuring thing mentally. Take the finances aside. If you knew that your mortgage was going to be paid off sooner, I bet immediately that would make you feel really, really good inside. And actually, our mortgage for most of us is going to be the biggest financial commitment we ever make. And actually, also each month is going to be one of the biggest expenses we have on a monthly basis. So getting rid of that sooner is, a massive, massive deal for most people. And also, if we think about things like inflation, cost of living, fast forward 25 years, Ben's extra £23,000 that he had over Sarah in our example, is it really going to be a big deal in 25 years' time over that £23,000? Maybe it's much more better off having that psychological reassurance that Sarah had that her mortgage is going to be paid off quicker and lose out on £23,000. For her, maybe that was the right thing, and maybe for you it is too. Again, there's no right or wrong answer. It's entirely what is your own preference, what suits your financial situation at the time you make these decisions. And you're not fixed into a decision either. So if you start overpaying your mortgage, but then you manage to secure your mortgage at a really low rate and you can get a better return on your investments, then maybe switch to investments. But in any case, to help you make the right decision for you, I've shared some brilliant resources and links in the description of this video. So take a look, work through them, and then let me know in the comments, what are you going to do? Are you going to overpay each month? Or are you going to put money towards investing? Maybe you'll do something in between like I do myself. And with that, thanks for watching, and I'll see you in the next video.